Welcome back. And just a quick reminder, we will have a replay of today's session today at 6 p.m. Eastern Time, which will include the curriculum as well as the question and answer session. Use the same login credentials as you have for each session. Each day, it's the same throughout. This section is starting on page right where we left off, 363 with Mark. This will go for about an hour, maybe just a little bit less than an hour. And then we'll have another break before we queue up the Q&A. We have a bunch of questions already. Same situation, try to organize them all in a single email. I'm getting multiple emails from people. That makes it very difficult, as well as be specific with the page number and any specific details you want to ask. General or hypothetical questions are really difficult for Mark to answer. And remember, we will have another question and answer session on the live trading day on Monday, November 21st. So that is something where you will have more opportunity and chances to ask questions that we don't get through to today. Also, just a reminder, we will get into risk management tomorrow. So there's some questions I saw on information or part of the curriculum we haven't even yet gone over. So do try to be patient, as you will learn more, including right now with selling and risk management tomorrow. So stand by for that, and let's get back to Mark and Mark, page 363.
Okay, welcome back. We're going to look at sell signals now, sell rules. And to do this, the first thing we want to discuss, and we want to go back to a satellite view even. We're going to go back to the stage analysis. And the first thing we want to identify is sort of where we are in the bigger time frame. Where are we within that stage 2, stage 3, stage 4 a maturation, part of the maturation cycle? And we're actually going to look at the PE ratio here as something that could help us identify if that move that has been made in the stock is getting long in the tooth, if you will. This is one of the few times that I do use the PE ratio where it becomes valuable. But even with this, it's only on certain instances where you even get this type of tip off. But the first thing that is very basic, and that I always do every time I look at a potential buy setup, these VCPs, of course, we're making sure it's in a stage 2 uptrend, but within that stage 2 uptrend, since the stage 2 uptrend started, I'd like to know what base we're at, how many VCPs set up. And the reason why is because we're trying to ascertain how obvious it is, and how, if it might be late in the cycle. So if we're on the 5th or 6th time that you've had a good sized base form, and the stock has made a really big move, and let's just say you've been in a bull market for a couple of years, that is what we would refer to as a late stage base. And we've got to be a bit more careful with that. That's not what I would call investment grade. That would be more of a trading opportunity, because the most of the juice is potentially out of the lemon, if you will. And it's no secret, once a stock has made a big move and there's been base after base after base, and all these breakouts have worked, it starts to get pretty obvious. And there's an indication there. That's giving you an indication that you may be late in the maturation cycle. So that's first. We want to know where we are. And basically the rule of thumb is, when you're in the 1st, 2nd, 3rd base, those are more investment grade, if you will, where you can try to hold longer. And when you start getting a 4th, 5th stage basis, and certainly if you get 5th, 6th, you're getting to where you got to start moving to a more trading type style, and sort of take the money when you have it, and get the money, get out when the getting's good. This perfect example is 2021, where we got into a late stage environment. I was tweeting it all year long on how a percentage of stocks above the 200-day were diverging, and there was less and less participation. And we had already made a big move in the market. And so I switched over to just taking short-term profits, and it worked out quite well. And then sure enough, we went into a bear market shortly after, within the next 6 months to a year. So those are the signs. And they could also be when you get a lot of late stage. My good friend Stan Weinstein, who is the one of the very first people to ever write about this, him and Wyckoff with stage analysis. He keeps track of what percentage of stocks are in a stage 1, 2, 3, 4, similar to how I keep track of the percentage of stocks above the 200-day. Very similar analysis. But when there's a lot of stocks, he calls them the good guys. When the good guys are in control, the stage 2, that's where the market's healthy. When you get to stage 3 or the stage 4, stage 4 is usually indicative of or signs that you're in a bear market when there's a lot of stage 4 stocks. Right now, you don't. Go ahead.
Just to point out, Mark, I just wanted to point out, if you just look at the character of this example in Amgen, how when you're doing the base count, each base is getting wider as it's going up the mountain, to the slide. Where are we on the mountain? As you go up, each one is getting subsequently wider. And that's one of your main tip-offs to say, not only are you on base 5 here, this is the widest base since the beginning of the move. It's telling you the stock, everybody's in. To Mark's point before, when there's thousands of funds that own these names, that's thousands of potential sellers, to create the other side of the mountain, if you will. And that's precisely the cycle we're in right now with, say, the old FANG names. All the funds own them, and they're now net sellers.
Right. And when you take a look, a couple of things. One, when you take a look at the stages and you go back and you look at a stock that has gone through the 1, the 2, the 3, the 4, the 4 stages and that whole life cycle, you'll find that during that stage 2, you'll generally have, before you get a decent sized correction or a top that's a secular top, you'll have anywhere between 3, 4, 5, sometimes 6 bases, and then you'll get that volatility. And again, with this Amgen, this is an arithmetic chart. If we go over to taking a look at Yelp, this is a logarithmic chart. When you get into really big moves and you're looking at longer term timeframes, you want to use a log chart, because the log chart will then adjust things percentage wise. What's 10% down here will be adjusted, will be the same here, even though the price is a higher price, right? A $20 stock just has to move $2 for 10%. $100 stock has to move, obviously 10 points. So you can see, as Mark just said, look how wide this later stage base is. Just like we looked at, I think it was Decker's, exact same situation where you came out of this primary base. Here's your first base forming, second, third, and then that later stage base here, that fourth, is very wide. It comes off about 50%, and this is a faulty setup. This is a faulty VCP, and sure enough, it tries to break out, but then it fails. It rolls over, because that's the indication that the supply is now coming to market. See, there's a lot of volatility now, and
you see too, Mark. Yeah, see, Mark, at how the volume is really piling up in terms of this fourth stage base as well, which tells you there are definitely institutional sellers. And then as the name breaks again, you see more volume coming. This is just, this is precisely what we're seeing in some of these names. You and I were saying earlier in this year, people calling Netflix and Facebook and, oh, they're great buys, they're off 30, 40, 50%. And you and I are saying, no, this is horrible. Institutions are going to be selling these names. And sure enough, all of those late stage bases have cracked and made new lows.
Yeah, this is just showing the characteristics for stage 3, what to look for, because that's when you're in that stage 2, and you start getting into these later stage bases. Sometimes a stock will pop up, and it'll have this big VCP, and you'll get excited about it, but you got to put it into perspective and make sure that it's not this late stage base that's already been 6 bases and now it's got this big correction. The big correction, some people think like that's an opportunity. Wow, it had this big pullback, and they like it because it's down big. No, that's just the opposite. You want the stocks that are holding up the best, not the stocks that are performing the worst. Once they start getting real volatile, that's getting where a lot of supply is coming into the stock. Now, the PE ratio, and again, this doesn't always happen, but you can certainly take a look at it to get some additional confirmation if you're late stage or not. And when the PE, one of the things of looking at the PE is to look for PE expansion. And that's what we want. We actually want PE expansion, because when you have a stock that's moving up, if the earnings are coming out very strong, as we showed in valuation in the Apollo example, you went up 200%. And then a year or two later, after a 200% move, the PE was the same, because the earnings were moving just as fast as the stock price. The stock price was just adjusting for the earnings, and you were basically at the same valuation, even though the stock went up 200%. Well, when you get a stock that starts moving real strong and there's great earnings and there's some great story and the company's making a lot of money, what happens is that when it gets to the later stages, it starts to go faster than the earnings, and the PE starts to expand. And of course, you want that. You want a price that, takes off and goes up as fast as possible. But that's where you want to start considering selling, because now the price is getting ahead of the earnings. And when you start getting to where you move up a couple, 2-3 times where you've expanded, and now you're at 20 times. The PE was at 20 here when it first moving out of that. We're back to that Decker's example, as a matter of fact. You're coming out of first base. I was buying right here. Now you have second base, a third base, a fourth base. Now, when you come up here and you start coming out of that fourth base, you're now 2 times, instead of 20 times earnings, you're at 40 times. You've expanded. You've doubled the PE now. When you get to 2 or 3 times earnings and you're on late stage basis, you are absolutely late in the game, and that's where you really got to be careful not to, especially kind of cut your losses, and you don't want to be holding and buying these stocks when they turn down, as we saw in valuation. That's where all the problems happen, right? So again, take a look at lumber liquidators. Another one we looked at before. When I'm buying it over here, right, this PE starts to expand. But when you go back and you take a look later on at that later stage base, this is where we showed the low volume out, high volume in example. This was that faulty base because it was late stage. You had the PE had gone, when you started the stage 2 uptrend, it went from 20 times earnings to 50. So now that means that the price is moving faster than the earnings. It's getting ahead of the earnings, and that means the price is going to come down at some point. And sometimes these really expand quite a bit. Like this is more than 3 times. This was Chipotle, where here's your first base, second, third, fourth. When you finally got to where it started forming this last base here, which did not hold, you were at 65 times earnings from 20 times. So this is just some big, broad perspective stuff where you're looking at the big picture. And this is also for longer term investors. If you're short-term trading, certainly all your trades are going to be trading opportunities, and maybe even these late stage bases you could trade, because you're going to have tighter stops. You're going to be trading at the strength, and this might not apply as much. But this was very simple analysis that I did with Home Depot back in the 90s, where the stock, a couple times I was in Home Depot coming off the 1990 bear market going to 91, and the PE had expanded dramatically, and I had sold it off of a late stage base, and then it went sideways for a number of years. It was 5 or 6 years, and then broke out there. The PE came back down, and then again, this big move, you see the PE expanded again, almost to right around the same level of up around 70, 75 times earnings. And then it topped right there. And these were both off of late stage bases. You had a base here, you had a base here, you had a base here. When you got to the 4th or 5th base and they had the PE expansion, that's where you're getting late in the game. Now, the other thing too is that when you get to that later stage, it doesn't mean, again, that you can't trade the stock. Later stage bases sometimes get what we call a climax or a blow off run in that late phase, where the stock gets really popular and just it has the biggest part of its move. This is the acceleration phase. The key is to identify whether you're early and it's a breakaway acceleration or it's an exhaustion. And again, when you count the bases, you take a look if there's been a lot of PE expansion, you've been up for a number of, maybe a couple years in the stock, a bull market's been underway, and now you get that acceleration after a bunch of bases. That's where you're going to sell right into that. We're going to show you that in just a second, some of the sell signals. Now, these stocks can also reset, just like we saw the failure resets with the pivot failure and the base failure. Well, on even a larger scale, you can reset. But what happens generally when you have a stage 2 that exhausts itself and then finally tops, and you get even a cyclical top can last years, and a secular can go decades. It usually takes a number of years, 3, 4, 5 years or more before you reset. And in this case, we reset over here. You got another new base. You're in a new stage 2 uptrend. See, it just starts all over again. Let me show you this example. This was Southwest Airlines. See, when you come out of this when you first turn into the stage 2, this first move here, it accelerates, but it's a breakaway move. You're in the early stage basis. Now you go 1, 2, 3, 4, 5 off of the 5th stage base. Now you're in an exhaustion. Now it's come a long way. It's come off a number of bases, and now you're looking for the sell signals. Same thing happened with Taser. Perfect example. I was in this later, and in part of that move where it started getting climactic. So when you first start, that's your breakaway phase. Then you get into the advancing, accelerating phase, and then the climax phase. That doesn't always happen, but when it does, and you're in the stock, it's nice. When your stock does that, you sell right into it. Qualcomm did the same thing. So many of these will start off like WR Grace. When I bought this, I was up in just 2 days. I was up 30% on it. So it was just starting to turn into a stage 2 uptrend. So I decided, what, I'm not going to sell this right here because it's just acting so strong, and it's in this early base. This could be just the start of before 3, 4 bases in this stage 2 uptrend. And this was a stock that was a company that was under heavy litigation for asbestos. They had a lawsuit, and that was resolving itself. And once that lawsuit got to a point where it was looking like it was going to resolve itself, the stock set up and was able to take off. So there was a fundamental reason behind the strength in this stock. So again, Tesla. So here's a perfect example in Tesla. You got that breakaway move. You got the bear market, the COVID bear market, set up that first big, deep cup with handle, if you will, had a number of bases, one here. And then you start getting into that later stage, right? And now we're getting more stage 3-ish, where the volatility is coming in and the moving average is starting to roll over. And now it looks like we're entering stage 4. Now this could be can turn back up here and maybe get back into stage 2, and we don't know when. But why would we try to buy it now in stage 4? I mean, I understand to buy it low, right? But we don't want the lowest price. We want the right price, right? So we want to be in stage 2. Remember, whenever you see your favorite name and it's down, go take a look. What stage is it in? All right. And remember, try to think back. 98% of the big winning names are in stage 2 uptrends before they make the big move. Do you want to be in, when you look at something like this and you're all compelled to buy it because it's Facebook, Amazon, Tesla, Netflix, Microsoft, NVIDIA, ask yourself, do you want to be in the 2% club or you want to be in the 98% club? All right, just be in this bottom fishing mentality. If you want to make efficient use of your capital and be in the stocks that move up and have big moves and make fast moves, you got to get away from this bottom fishing mentality and this cheap and buying quality. There is no quality. There is no quality in the stock market. If it doesn't matter, all stocks are risky. All stocks are bad unless they're going up. So that's the fundamental basis. That's the fundamental a starting point for being a super trader. So we're going to go over some specific sell rules now. I don't know if you have anything to add on that.
Well, I was just going to add too, Mark. I think this is really this list and sort of going forward, but to your last point as well about not getting lured in by buying quality. But for folks who are going to try and play these names for a bigger move, this section's really important because this is what's going to give you maybe you've been in a name like a Tesla, for say 12 months in the last cycle. but you want to look for, some of these signs to consider. If you're shorter term in nature, you're going to be trading multiple moves as a stock makes base after base. But for those of you who are looking to play these names for bigger moves, it's really this section I think you want to key in on to say it's time to, part ways with the name, because there are plenty of generally warnings ahead of time to tell you, and that's what we're going to go over next.
Yeah, and money always finds a home. While your stocks that are going in stage 4, that money is coming out and going somewhere else. Your job is to find where that money's going and to see where the stage 2 uptrends, where the new VCP is setting up, and the new names and the new technologies that are now the new leaders. All right, that's the key. Remember, money always has to find a home, so it's going to go somewhere. Anyway, let me show you something that Mark said about playing stocks for bigger moves. I'm going to show you how you're going to look for these same sell signals are going to be whether you're selling for a shorter term move or a big move. All right, they're both. And as a matter of fact, what's good in the short term sometimes is not good in the longer term. The same exact. That's what makes these rules kind of easy to follow. So you remember we talked about confirmations? We had a bunch of days up, like there was. Let's just say there was 9 out of 10 days up from a breakout. That's positive, right? That's a confirmation. Well, once the stock is extended, that's actually a negative, right? That's what you want to sell into, that strength. So that's why it's important to decipher where you are. I say, where are we on this mountain? Are we on the first base camp, or are we on the 5th and we're near the summit? So when you have 70% up days over down days or greater, especially when you have 2 tranches of that, and I'm going to show you exactly what that looks like here. So stock starts making a pretty good move. Maybe you bought the stock earlier, maybe you bought it over here, you've gone through a few pullbacks, and now it starts to accelerate, right? And here, 8 out of 11 days up. All right, so you say, well, that's a confirmation, that's good news. Yes, but now that you've gotten into a later stage move and you're at a good sized profit, that's where I start to sell. I start to sell into that. That is now a negative. What was a positive breaking out of a base, once the stock gets extended and starts to accelerate its rate of advance, it becomes a negative. And what I found is when you get 2 of those sort of back to back, and with that, you can look for, you'll get sometimes the largest up day since the beginning of the move. You'll get the widest spread. What you want to do is you want to start either selling into that strength, or at the very least, backstopping and watching for specific signs that institutions are jumping ship. And what the next thing you would look for is for heavy volume, a reversal on the heaviest volume since the beginning of the move. So now, you're up and away, and now you get that big reversal right here. You can see that reversal, and you engulf the previous day, and that's the largest volume through this entire move. Now, that's usually a sign where, if I were fortunate to be in a stock like this and hold this for this long, I would certainly start to reduce my position there, or as it starts to come down from there, I backstop it, and I would definitely be reducing. Then the real negative, and this just happened in a bunch of names. You can go back and look at Facebook and most of these stocks that just got annihilated in this last bear market, that were the secular leaders that topped. Almost all of them had big breaks on the heaviest volume. That's an absolute sell signal. When you have the largest down day on the largest volume since the beginning of the move, that is an outright run for the hills, because that's a sign, like we talked about before, that institutions are piling out. They're unwinding those profits now. So, and sometimes these all culminate together around the same time, but in chronological order, this is what you're going to see. First, you'll start running up, you'll accelerate, you'll get a number of days that are up versus down days, and you'll have 70% or more of those days. You'll start to see the largest up day, wide spreads, and then after you get all that jubilation, then the selling will start coming in, because institutions liquidate into strength and they sell into the retail hands. Let me show you some more examples. This is where this does get a bit more complicated. It definitely gets more subjective. Mark, have you found that the selling side, because almost everybody that I ever talk to when I train traders, is the selling side and nailing down the profits and managing the trades that are profitable tend to be more frustrating or more difficult for people than handling the losses sometimes, where you set your stop and you're out at a level. This becomes, there's a lot more a skill that you need to develop for this. And I think the real thing is that there's no perfect sell point at this point. You're just trying to make and capture a really decent gain versus what you risk. Can you speak to that?
Yeah, absolutely. I would just agree 100% to say almost all the real pros I respect, their focus and art is on the selling side, because in terms of profits, managing winners is the trickier part, because losers, they're just a cost of doing business. And every pro I know, that's has been in this game a while, the reason they're still in the game is because they've learned to manage those losses almost just like like a bodily function, like a cost of doing business, where those winners, you're trying to, squeeze the optimum amount of juice out of the lemon without, hanging on for the last drop, in the same way we want to be the last weak hand in the name. We don't really want to be the last weak holder. We want to sell it, before that and lock in a good, meaty part of the move. But your last point, I just want to emphasize, when you see like that gigantic volume, to the downside, that's the opposite of, just exactly the opposite of what you want to see. That is a horrible sign, because just earlier, it's not, Aunt Betty or whatever analogy we use, buying a few hundred shares for her Roth account or whatever. That's not her selling a few hundred shares. That is massive profit taking. The pros are getting out, and they're telling you that they're getting out. They cannot hide their hand, guys. I can't emphasize this enough. So, any stock that has the largest decline on volume since the beginning of the move is probably off my radar for months at that point. Because it's just going to take a lot of time for that to potentially reset up, because it's telling you there's supply now sitting over that stock.
Yeah, the beautiful thing about charts and looking at price and volume is that the elephant can't get in the bathtub without the water rising. There's no way. You're going to detect it. You're going to detect the footprints of institutions. And in contrast, you're going to be able to detect the footprints of retail. And by being able to detect that, that's when when the strong hands are in control. And that skill is a very valuable skill to develop. It's going to take you a while, but believe me, it's well worth it. So now one of the reasons why selling is so difficult, especially using the type of techniques that I'm talking about and getting out when the getting's good. One of the reasons why you want to do it that way is because once the stock breaks, you're way better off selling into strength even at lower prices, because they'll break so fast that they'll give up a lot of your gain before you recognize that the stock is turned around, and using moving averages or whatever you may be using, what the common person uses. By the time they start showing all those signals, they've given back a huge percentage of their profits. And I'm sure you've been through that. You've experienced that yourself. So by selling into strength and starting to see when you get a bunch of up days versus down days, a bunch of good closes, and it looks just like what you're looking for with the confirmations, but now the stock price is accelerated and you're at a good size profit now, and you're seeing largest up day, widest spread, and you're really getting that jubilation, that exuberance in the stock. You, just like everybody else, you're elated. You're so happy, right? You're thinking this stock's going to the moon. You're looking at, Morgan Stanley just came out with a 2,000 price target. I remember they did this with Qualcomm in the 90s. This price target was like $1,000 above where it was trading. That happened with, I'm sure that happened with Tesla and some of these other names at some point, where you start getting these price targets. That's where, you've got to really calm your emotions, look at the chart, and nail down a decent profit. Here you see where this stock, it's just meeting everything after it accelerates itself. And again, maybe you bought it right here. This is a perfect little VCP, little coupled handle. You could have been buying here, whether you bought earlier or you bought here. Now, after you make a nice move, it goes up from 12, 16, it goes up to $18. Now it accelerates. In just 4 days, it runs up 47%. You got the largest up there, the widest spread, multiple gaps. We're selling right into that. We don't care if it goes up tenfold from there, because we're getting out when the getting's good, and we're selling right into that strength. And that's the way you nail down these profits, and you keep your. Why don't you also speak, Mark, to the other benefit of this is your equity curve, right? What happens when you're selling to strength? What is that guarantee that you do with your equity curve?
You're smoothing it out, and this is an absolute pro tip, if you will, or advanced idea, that because the amateur just thinks, well, but the stock might go higher. So let's say you get that first largest up day where it gaps. As far as your equity curve, though, let's say you sell the whole position there versus selling it 3 days later when it comes back down to the same price. Well, the amateur might think, well, hey, I achieved the same thing. But the reality is your equity curve just got much more volatile, where the individual who sold on that first large up day, he maximized his profit and locked in his equity curve at that level rather than taking it higher and then back down. And for those of you who don't understand what I'm talking about, with time and experience, you will. And to Mark's point, you want to continue to add alpha. And the best way to do that is to use that strength, especially that outsized strength, where this stock's been moving up in a nice trend, and then it accelerates. That is that sign to say, lock in some of those gains and take advantage of that strength for selling.
So regardless of if the stock goes higher or not, when you sell into strength, you're selling at the highest price that the stock is traded up to that point. So you have no drawdown at all, right? Your equity curve is at the highest level. And this is why when you take a look at someone like Mark's trading or my trading, or anybody who's really good at managing risk versus reward, and they're using strength for selling, and they understand this, you're going to see this stair stepping where their account will go up and then it'll just flatline, and it won't go down very much, because they're always selling and protecting that drawdown by selling into strength and not allowing the stocks to come back very much. And this is where, this is on one stock. If you have a whole portfolio, and you've got 10 stocks and everything's going great, it's just like when you go on, for those of you who ever played craps in a casino, you go out there and you put some money down, and now you've got the 8, and then you put some money, another roll, you start putting bets on there, and before you know it, you got a whole bunch of bets on the table. You got the 8, the 6, you bought the 4, and you took a hard way, and 7 out, boom, you lose them all. Right now, there's this giant drawdown. You've built up all this money, but it's out there exposed on the table. So that's what really hurts your performance more than anything, more than not getting the gain, because even small gains can add up. If you can minimize the downside and you don't have much drawdown. If you're not losing, winning becomes much. The first rule to winning big is not losing much, and that goes for having drawdowns. So let me show you a few more examples here. I know we're getting a little long-winded here, but so here again, stock gets into that stage 2 uptrend, and this could also be, it doesn't have to be a late stage. This have to be a 4th, 5th stage base. This could be the very first base. And maybe if you're swing trading, this is precisely how you want to trade and trade out of these positions. However, if it's a later stage base, it's even more important, because then the stock it has a potential of breaking faster and even harder, because now the stock's gone up so much for so long, it's become obvious. You got all these institutions in there, and now there's nothing but supply. So here, 11 out of 15 days up, right? That's your first run up. Then you pull back here, you actually get a little cheat area. You get another little opportunity, whether you traded out of it and you bought it back, or you stuck with it, or you add it to your position here. But now you get that second run up, where when you get 2 of these somewhat back to back, usually they'll happen either back to back with a little pullback in between, or one base in between. 70% of the days up over a couple weeks, 11 out of 15. Now you got 13 out of 15 days up, largest up day, which if this was breaking out of initial base, this would be a great sign. I probably would hold the stock and let it go through a couple pullbacks and try to go for a bigger move. But this is happening after it's already moved up quite dramatically. This stock came out of this first base here, $8. It's now a double in a short period of time, and it goes up 53% in just 5 weeks on a gap, largest up day. See, this is all starting to come together big volume coming in. It's getting very climactic now. So that's where you want to sell right into that. Same here. Here's Tesla. And again, sometimes it doesn't mean that the stock has to top out forever. Sometimes this just is enough to stall the stock for a period of time, sometimes 6 months, a year, where you could then move that capital somewhere else. But again, you came out of this base right here, bunch of gaps, 1, 2, 3 gaps, largest up day, widest spread, up 10 out of 14 days, up 51% in just 14 days. See, again, I'm selling right into that. I'm selling into that every time. I'm selling right into those, all those sell rules piling up. And then you see, sure enough, stock comes in, you give back all that gain. I'm not going to go through every one here. Well, I'll go through them just really quick. Again, largest up day, widest spread, 1, 2, 3, 4 bases, and now you get the acceleration, 58% in 5 days. If you're not happy with that, even if you bought it from here, just the 58% in 5 days, not considering that you bought it earlier, would be a nice quick return on your money. Again, here you see, comes out of a base here. Now getting later stage. This is actually on earnings. Sometimes you'll have earnings and the stock will gap and top on good news. Again, for some, it might be hard to sell because, oh my God, they just came out with this great earnings report. 50% in 9 days, up 7 out of 9 days, largest update, reversal off the top on the largest volume. So this really, in one day, you've got a whole bunch of sell signals all at one time. All right, let me show you a few more. Same thing here. Now, another thing to look at here, I talked about acceleration. What does that mean? Well, first we come out here, right? Then we accelerate here. And now look at the angle of ascent here. You see how we keep our angle is getting steeper and steeper. That's where when you get late stage, as you start to accelerate, this is unsustainable. When you first break out, it's unsustainable, but it's early. So you get some pullbacks, you'll get some rebasing, and the stock can move higher. Once the stock makes a big move and it's run up and it's got extended, and it's on gaps, and all these things have occurred, that acceleration now becomes unsustainable. And usually the selling that comes into that, the big institutions, they'll start selling into that, and then they'll overwhelm that short-term demand. That supply now will work just the opposite. As it was gobbling up the weak hands, it's now going to run over the weak hands. It's going to take those weak hands out, and there's going to be no bids.
And Mark, the way I like to describe this sometimes, that's helpful for folks, is everybody's ever gone up a hill. If you start jogging up the hill and then running, if you sprint up that hill, at some point, if you don't stop, you're going to collapse. And that is precisely when these stocks start going parabolic like that. You can see, as it shifts higher and higher, whatever your analogy, same when you ever into an air show and that plane flies straight up, it's just, it's telling you it's going to have to stop. And the longer it goes without, to your point, you're risking then that bidless situation where it gets really volatile. And that's what you don't want to be around for. So even if you sell early beforehand, you're avoiding that volatility, which will pay handsomely in the long run.
Yeah. Selling into strength is the hallmark of a pro, and is one of the key points to making big returns and having low drawdowns and being able to compound your capital. And I can't stress it anymore how important it is to get good at selling into strength. Now,
that's something everybody should write down, by the way, that selling into strength is a hallmark of a pro. That should be on a sign somewhere.
As Mark was saying, that think about it as here, you just start a running competition and, you're completely rested. And now as you start running, that initial, you come bursting out of the starting gate, and from being rested, obviously your heart rate now moves up, but you can go and run the race for quite a while, right? You go through this marathon race, but at the end of the race, you're all out of energy. Your glycogen is all depleted. You're tired. Your heart has been racing, and now if you were to then push yourself and accelerate from there, you would not be able to go very far for very long. It's the exact same thing that happens with a stock. So think of it in those terms. So again, just looking at some of these examples, I'm just showing you examples of how stocks will either top or stall And you can see again, up 7 days in a row. This is making me happy here. It's breaking out of the base. This is one actually, Fair Isaac. I bought this right, coming right out here. Runs up. You get another little base here. 7 out of 10 days again. Now, okay, now we've made a nice little move here. You know, we've doubled, and you get the big break. Price break on the largest volume after you've had these number of tranches of 70% or more up days, and now you start getting toppy. You come, the 50-day can't hold, and you see you come off here. This is something you got to get really good at identifying on the upside on your profitable trades, so you can avoid getting caught in the downdraft. And this is what the downdraft looks like. This is what Mark was talking about earlier. This is like the last straw. I mean, this is the straw that breaks the camel's back. This is the absolute. I am virtually never in this situation unless it's by pure surprise that there's like an earnings report comes out and I'm torpedoed, or some news comes out of nowhere. Otherwise, I'm never waiting for this type of scenario. But the largest break on the largest volume, daily and weekly. This is a weekly here. That's the largest weekly down week on the largest weekly volume since the beginning of the move. That is about your biggest sell signal, or biggest signal that institutions are piling out of the stock, and that it's just the beginning. It happens over and over and over. You see again in lumber liquidators, you had that first selling off the top here, big down day. That's your biggest down day. And then it comes off. And after it's down considerably, another one, boom, right? And now the stock is actually cheap. You know, there's people were making a case for this. I remember they were talking about how it's trading low, its lower range of its PE ratio, and it had a little pop from that, and then boom, that selling comes in again, and now it really starts to pick up. And now after the stock is down, all of a sudden the PE jumps because all the bad news starts coming in. See, the smart money's getting out, anticipating the bad earnings, the bad news, that all of a sudden what looked cheap is more expensive than ever, literally almost overnight. This is how it works in real life. All right, here's TME. This is one I bought right here, and this had a pretty short lifespan. Was acting fine, had a little volatile right here. It came out of a base, but look at that reversal. That is definitely low volume out, high volume in. So if you're buying off of this base right here, this would be, you know, run for the hills. But big break, volume comes in, and you know, that was it.
Mark, yeah, this was a good example. This was actually a name I was planning for a bigger move, and I blew out of the remaining shares on that big break day. It was just a classic, you know, five alarm fire going off, saying, you know, major change in character.
Yeah, so this was the daily on TME, and this was the weekly. So see, they both took that day first, and then that week was giving you a clear cut out there. This is a snap that was recently, and I compared it to Crocs. If you see, Crocs came off the highs and just wham, that was it. And same thing with Snap. Snap came on. I remember there was a bunch of fundamental investors that were loving Snap here as it was coming down. And I know many of them have been selling it recently, now that it's down, I don't know, 70, 80%.
Snaps down even. Mark, it's funny, go back to that chart just to highlight this. You know, we often say, you know, if something falls 80% or 90%, how much more can it fall? Another 80 or 90%, because I believe Snap just in this last earnings lost another 30, 40, 50%. I think it's trading, you know, in the low teens maybe now.
Okay, yeah. So yeah, this chart is
just got worse.
Yeah, and Meta, Facebook, of course. Remember, highest PE before, just like we showed in the valuation section, Meta, previously Facebook, was no different. Highest PE before a big move. Now has the big break. This is the largest down week since the beginning of the move, and the volume was big on this. I don't have it here, but at the lowest PE, it's the lowest valuation. It's the cheapest right here. And then, this, of course, I believe is down even further. This is as of 10/23. It broke again just recently.
Yeah, it's under 100 currently.
Yeah. So now, I think, let me just see here. Okay, sorry. Yeah, we're going to keep going. All right. So I want to show you here a couple sell rules, or that we looked at sell rules on the upside. I talked about selling into strength, but you also can use sell rules that are selling into weakness. Okay, and so that would be backstopping. Sell rules that you would require the stock to come down and hit some level based on either, in this case, we're going to base it on a moving average. So we call this the 50-day break even or better rule. And let me just say that this rule is best used in the early stages or the early buys that you have coming out of a bear market. When you first go back into the market and you start buying some of the initial movers, the stocks that are meeting that criteria that we talked about, the relative strength lines moving into new high ground, stocks that moved up the strongest off the lows, got into new high ground first, the leaders. You get those leaders that are coming out of their bases, out of those VCPs, right in the beginning of what could be a new bull market, because you're in a bear market. So stocks that right now we're in a bear market, stocks that are starting to break out of bases, these are the ones where you might want to take off some into strength to cushion your risk. You know, if the stock goes up 10%, you've got a 8 or 10% stop. Well, now you're free rolling. If it goes in and stops you out, you are breaking even. So you've de-risked the trade, right? You've removed the risk. However, so if you want to play it for a real big move, you can, when you first get into these stocks that take off out of those initial bases, they can go a tremendous distance before they even have a close below their 50-day moving average. And going back to the AccuStaff, remember I bought that 1,000 shares of AccuStaff back in 95. That stock went up 400% before it even closed one day below the 50-day. So this is where we came up with the 50-day or better rule, where what you do is you have your stop, right? But once the 50-day moving average moves up to your break even point, then you switch over to the 50-day. And I like to use a close, but of course, if it close would mean waiting till the end of the day. So if it was getting much below the 50-day, it would be a judgment call whether you sell intraday or you wait for the close, because obviously you can do a market on close, but it would have to be below the 50-day. But the general rule is that you're going to let that stock, ride that 50-day, and until it closes below it, or even a weekly close. If it just closes a little bit below it and you're near the end of the week, see how it closes the week. Sometimes it'll come back. It'll end the week above the 10-week. And this will allow you to not only lock in some profits that are probably even bigger than you would get, maybe selling into strength earlier, and occasionally you'll hold a big winner where it'll just make this big move and it won't undercut the 50. I use this on occasion, like I said, and I use it on usually a parcel position. Usually it's on 50% or 25% of my initial position. I'll swing trade out a part of it. And then if I think I'm starting a new bull market and I've got some key leaders and I don't want to let the tiger go by the tail, then I'll switch over to the 50-day once it hits my break even, and then I'll just let it act as a trailing stop. I just showed you a few examples. These are a few stocks that I traded and I use this rule for. The other thing that you can look for that in connection with this is that what we found is that stocks that are leaders can go a tremendous distance before they make more than 2 lower lows, where they make 3 lower lows. Remember I talked about 3 lower lows, looking at the daily after a breakout. Every lower low after 3 lower lows becomes more ominous, especially if it's on volume. You have bad closes. So you're counting those lower lows after 3 lower lows, and you want to see supportive action around that second, third, fourth lower low. You want to see supportive action. The same thing with weekly charts. And what we found was, if you just held a stock, many of these leaders, and held it until it made 3 lower lows, it keep you in the stock for a tremendous distance. This one right here, which is Burlington, which David Ryan and myself, we were both buying coming out of this initial base here. It went a great distance before it got below the 50-day or the 10-week moving average in this case, and had 3 lower lows. So either rule would have kept you in the stock for a long way. You can see right here, BABA comes out of this nice formed VCP, and all the way up through this move. Again, this is only 2 lower lows. You have not gotten 3 lower lows yet. and this is something, this is an observation that David and I worked on and confirmed by looking at a lot of the market leaders and looking at it in conjunction with the 50-day, the 10-week, and counting the lower lows. Again, it's not going to always work this way, but it's a good rule of thumb to just to watch the stock, and if you want to try to play it for a bigger move, count those lower lows. And again, see, here's 2 lower lows, 1, 2, and you'll see that supportive action. Each time you get those few lower lows, you get supportive action. That's because institutions, when there's an appetite for a stock, something really great's going on, they step up to the plate. After you got a couple lower lows and pullbacks, they step up to the plate because they don't want to run the stock up. They don't want to defeat the purpose of buying the stock. If they just keep staying in there buying these big a number of shares, they'll run the stock up. So they'll back off. Like I told you earlier, stock will run up a bit, they'll back off. Then when it pulls back, they'll go in there and they'll absorb that short-term selling. They'll absorb those weak hands, and the stock will get back into that uptrend. And then again, they'll back off. It'll pull back again. And when that character is what you're looking for. And when that character changes, and now it's the opposite, where it's rallying back, but it's getting a lot of lower lows, and just the opposite happens. Now the reverse. They're selling the shares. The bigger money is selling the shares, and they're not gobbling up the supply. They are the supply. Okay. These are a few general rules for selling, particularly for swing trading. What I do mostly. Once you get a multiple of your risk, and Mark, you might want to talk about some of your sort of general rules of thumb, because I know, when you go into a stock, and if your average, if your loss is 5% or your risk is 5%, you're not usually selling a stock if it's up 4 or 5%, because you're not really achieving any multiple of your risk. So when you get a multiple of your risk, when I get where I'm 2-3 times my risk, let's say I risked 8%, and now the stock's up 3 times, 24%, 25%. I consider selling half my position at that point. Basically, I consider a couple things. One is selling a part of my position and financing my risk and allowing the stock to go to my stop, but I just break even. If I'm at a real decent profit, maybe I'm at a couple times my risk. Now I can sell half my position, move my stop to break even, free roll the trade, and still guarantee myself a profit. So if it comes back and it stops me out, I guarantee myself a profit. I also look at my average gain, and I'm going to let you talk about this too. I know you're going to talk about many of the same things, but you'll have your own take on it. My average gain is what I'm also monitoring. So you should always take a look. What's your average gain? Look at your last 100 trades, your last few hundred trades. If you don't have that many, look at whatever trades you have. What's your average gain? If your average gain, let's say, is 10% and the stock's 20, Mark, this is where I'll let you take over. What happens to your average gain when you sell a stock above your average gain?
It improves.
Improves your average gain.
Right. It improves your average gain. And we'll, we're going to get into this in terms of the math later. And yes, what we talk about, you want to let the math and the metrics work its way into your trading and help you make better decisions. So to Mark's point, when you have a good understanding of those metrics, it will help you manage positions better in real time. And that's the key, guys. Remember, we're looking at a lot of these past precedents, and this is really important to have pounded into your head. But, in real game time, that's where you want to let those things help influence you to make the right decisions. And I just wanted to highlight, though, that the Alibaba example is a really good one, because you want to think of some of these, we're giving you a lot of different tools, guys. And the key is to know how and when to use these tools. So we've got all these different entry techniques. Well, this was one particular one where, I think in the first Master Trader program, we didn't even have the 2 lower lows. You and David had developed that as kind of a rule and even set some of those precedents. And I remember, having an enormous position in this stock because it was set up perfectly. And this is the weekly. And then, switching over to Mark's point, where you can use that 50-day trail in combination with sort of 2 lower lows. And this stock just, and this was a big name. And I think this is one of my first individual $1 million trades, which is why it stands out, because I was able to put everything together to say, look, everything's, and it had earnings, it had all the fundamentals coming out of a primary base. And then you got the perfect breakout where you're able to put a big position on and then finance a hold with what would have been a larger average position for me. So you want to see everything kind of building together. And it takes some time to master these things. And to our point about how the pros really focus on selling right. But you can just, really make a huge giant step forward in your performance as you start mastering some of these techniques. And I'm really a hybrid, to sort of explain where I'm not always looking to play things for a bigger move. But when I see that good follow through action and the stock isn't showing violations, that's where I want to sell a piece to finance that hold for a bigger move. But, everything comes with a cost. There's no free ride. If you're going to play the 50-day or trail rule, you just have to understand too that you have to cut a position to the size that you're comfortable holding, because you're going to have to sit through some pullbacks. And if your position's too large, you're going to wind up, putting too much volatility in your portfolio.
Yeah. And let me see if, okay, I want to make sure my microphone was on. And we're saving the best for last. The risk management section is one of our final sections. And we're going to talk about a lot of this in position management. So we're going to get deeper into this. We're going to get very, very deep into the math and the risk management and the position management and some really interesting techniques and some very mind-blowing things that it's called mind-blowing math that we're going to a section that we're going to talk about that you're going to be blown away. So we're going to get even more deep into this, but we're going to conclude today. Right now, I also put some other warnings that you can look for. You look at those charts, you go back and look at those chart examples, and you look at these tables that I'm giving you here, and you can start putting that together. And these are the warnings that you should be looking for, and the specific sell signals to get out of those stocks that you're profitable on. All right, so we'll conclude now, and then we'll see you next. I'm not sure what we're doing with another Q&A or not, so we'll find out. We got to let Bob talk here, and we'll figure out where we're going next. I just go where they tell me. All right, thanks, Mark.
Absolutely.
Yeah.
All right, guys, that will conclude the curriculum for day 3 of the 2022 Master Trader Program. We will be starting the question and answer session in about, let's take maybe 25 minutes actually. So to give a little bit more time for you to take a quick break, as well as let us set up, get our questions in order. A bunch of them have been coming in. With that said, questions can be emailed to bob@minervini.com. And also, just as a quick reminder, we will be having the recording replay tonight at 6 p.m. Eastern Time. Finally, you will use the same login credentials for all sessions, including the live trading day. We will also have additional time for questions and answers on Monday. So please realize that we have been getting a lot of questions, more than what we'll ultimately be able to get through, but we do aggregate and congregate the general questions that are very similar to each other and do cover as much as we can. Also, a quick reminder is I know there have been some questions here that I see been posted about the Minervini private access services. Again, we're not really going to talk about that in a forum, but you can reach me at bob@minervini.com, and I'll be happy to go over any details related to the private access daily service, which we offer from Minervini Private Access as well. With that said, again, let's take about, not sure if we're going to put the timer up here for 20 more minutes or so, but no. So about 12:45, as they made, it's 12:22 right here now where I am, East Coast time. So why don't we say just about 20 minutes? And with that said, we'll be back and see you at that time. Real quick, you do not need to leave the room. the room will stay open, but we'll pick it back up at 12:45.
Recording stopped.